In this lesson, I'd like to consider markets for physical capital and for housing as a particular example of physical capital. We've considered lots of markets throughout this discussion, throughout this course. We've considered labor markets, we've considered markets for pumpkins, we've seen markets for delivery of pianos, all sorts of things. But what we haven't focused on are really markets for capital and markets for housing. And these are a little different than the other markets. The prices tend to be volatile. They tend to be affected by people's psychology sometimes. So we want to look at it carefully. When you think about physical capital, let's be specific about what we mean. Economists mean things like trucks or computers, office buildings, houses, the things that are part of the production. So if you're moving pianos, you not only have to have the workers, you have to have the trucks to put the pianos in as you move them. And if you're running a firm, you got an office building, not just the people who work in the office building. So the capital is part of the production process. It's an input to production. It's a factor of production. And that's the physical capital that we're going to focus on in this lesson. There's also financial capital. Those would be stocks and bonds. We're going to consider that as well. And to be complete, there's also this concept of human capital, which we have touched on in discussing labor markets and income distribution. Human capital is the skills that people accumulate as part of their education, part of their training on the job. They're able to be more productive, more efficient, more capable with more of this human capital. Human capital is just a term that refers to all these skills in education that make a worker more productive in the firm or in society. But today we're going to focus on physical capital and really think about what determines its price, how much is produced, etc. So let's consider an example. First of all, this is a picture of housing prices in the United States. In recent years, goes from the mid-70s until the present, and you can see on the vertical axis the median price of houses in the economy. And it's accelerated a lot around 2002 or 2003, reached a peak, and then collapsed. And many people think this run-up of housing prices had a lot to do with a major financial crisis that happened in 2008 and 2009. But in any case, you can see there's quite a bit of volatility. The price of houses, the median price of houses, nearly tripled during this period of time. And so it's something to get your hands around, try to understand what's going on. And housing is an example of physical capital. It's actually the house or the apartment buildings where people live. So let's sort of get our hands around how we're going to analyze this. I want to start with a general consideration of the demand for physical capital and how economists think about it. And to do this, I want to first consider a case where capital is rented. And in this case, the firm has to pay some rent to get the capital. So let's imagine food trucks, for example. Suppose you're in the business of giving lunches to people in the city, and you have food trucks to do that. It could be different kinds of food trucks, maybe Indian food or maybe just hot dogs. And so we want to consider how many food trucks a business might want to have in a particular community. And we're going to consider the situation where there's a rental market for these food trucks. And of course, there are rental markets for food trucks. If you want to go into business, you don't have to buy a food truck necessarily. You go out and rent one. So how does this work? Well, let's consider a numerical example. Suppose that this firm has decided how many food trucks to rent for a month or for a year, whatever it happens to be. The first column shows the alternatives. You could 0, 1, 2, or 3. In this case. And of course, you're going to get more revenue with more food trucks. If you don't have any food trucks, you don't get any revenue. You can't serve any food to people. If you have one food truck in this example, you can sell enough to get $3,000 in total revenue. If you have two, you can get $4,500 in total revenue. If you have three, you get $5,000 in total revenue. And in this case, we have the concept of marginal revenue product, but of capital. We've considered marginal revenue product of labor in the past. Marginal revenue product of labor is how much revenue increases when you hire an additional worker. In this case, marginal revenue product of capital is how much revenue increases when you get another unit of capital, such as another food truck. So as the third column illustrates, when you go from 0 to 1 food truck, you get $3,000 increase in marginal revenue. When you go from 1 to 2, you get another $1,500, from 3,000 to 4,500. And when you go from from 2 to 3 food trucks, your marginal revenue product of capital is 500. So from this, we can derive a demand curve. So I'll put on the vertical axis here a amount that will represent the marginal revenue product, and I'll put on the horizontal axis the number of food trucks that are rented. And so in the example, we had 0, we had 1, we had 2, we had 3. And then we considered different marginal revenue products. So let's put on the axis 1,000, 2,000, 3,000, and so on. And then I want to plot the marginal revenue product of capital that we computed. So if you recall, for 1, it was 3,000. For 2 food trucks, it was 1,500. And for 3 food trucks, it was 500. There they are, the plots. So I just, again, mindlessly plotted those numbers from the table. Now we can ask, what is going to be the quantity demanded of food trucks at different rental prices? So for example, if the rental price is over here somewhere, let's say 3,500 or 3,400, that's going to be more than the marginal revenue product of 1 food truck. So the firm will not get any food trucks. It won't go in the business of providing lunches at that high rental price. But as the rental price falls to 3 or just a millicent less than 3, it'll produce 3,000. It'll produce that 1 food truck because the marginal revenue is greater than the rental price. And then if you lower the price further, you're going to stick at 1 until you get the marginal revenue product equal to the price, which is at 1,500, and you get 2 food trucks. And you continue that way until you get 3 food trucks when the price is equal to $500, or in this case, below $500. So what we've just done is derive demand for food trucks, demand for capital more generally. It's downward sloping. As is often the case when we derive this numerically, it looks like some steps, but nonetheless it's downward sloping. And if you had more options in terms of number of food trucks, or you had a lot of food trucks in the area, a lot of food truck companies in the area, this will become smoother. And so based on these considerations, you'll get a more smooth-looking curve for the demand for physical capital, and it's downward sloping as shown in this picture. So on the vertical axis, we have this rental price, how much it costs to rent the capital. On the horizontal axis, the firm's quantity of capital demanded. And it's simply just the marginal revenue product of capital in the picture. To get the market demand, you'd sum across these horizontally, as we've shown in other examples in this course. Now let's consider the fact that in reality, many firms don't rent. It's possible, but some actually buy the food truck. So how does this change in the case where there's a decision to own the capital, own the food truck? Well, what we want to do is argue that there's an implicit rental price of capital that replaces the rental price if it was a real market, if it was a rental market. The implicit rental price is equal to interest plus depreciation. Why is that the case? Well, when you buy a food truck, it's not like you're not paying anything. You were paying rent, but you pay something. When you rented it, you paid rent, but now you're going to pay something else. What are you going to pay? Well, most likely you'll have to pay some money to the bank to borrow the money to buy the food truck. Also, the food truck will depreciate over time. It's going to be worth less after a year. After 2 years, it'll start to deteriorate. More maintenance will be required. So both of these things have to be taken into account if you're owning the food truck. And there 2 things are the interest you pay to the bank to borrow, plus the depreciation of the capital of the food truck. Here's another example in the case of computers. Same idea, you can rent computers or you can buy computers. If you buy computers, there's this implicit rental price. If you rent them, there's the rental price. In the case of buying them, let's suppose the price is $4,000. Let's also suppose the interest rate to borrow to buy this computer is 10%, so 0.1. And let's suppose depreciation is $1,000 a year, so the computer's because of new computers being designed or just the actual deterioration of that computer, it's worth $1,000 less at the end of the year. That means the implicit rental rate is 0.1 times the 4,000 plus 1,000 for depreciation, or 1,400. And that's the implicit rental rate. For a firm deciding whether to buy one truck or buy 2 trucks or buy 3 trucks, the considerations are exactly the same when you have an implicit rental price than if you had an actual rental price. If the implicit rental price is greater than the marginal revenue product for one unit of capital, in the case of the food trucks, if the implicit rental price was greater than $3,000, then the firm wouldn't get in the business of food trucks at all. And so on. If the implicit rental price falls, we get 1 truck or 2 trucks or 3 trucks, whatever it happens to be. So the analysis is exactly the same, and it's a little more abstract because we're thinking of this implicit rental price rather than just going to the nearest firm that rents out food trucks. You now buy the food truck, but it's basically the same kind of an argument. Once we've done this, we now have a whole market description for capital for food trucks. We just derived the market demand for food trucks or capital by summing across all these considerations for the different firms in the business in the area. We also have the typical market supply of capital of the food trucks. That's the marginal cost of building them, or maybe they're going to reconvert a truck or a trailer into a food truck, whatever you have to do to produce a food truck. And so that's going to be the market supply. And we're going to argue that the price of food trucks, or the price of capital in general, is at the intersection of those two curves. We get a price and we get a quantity. So once we've derived this demand curve for capital, we get the same kind of stories we had before, and we can consider shifts and movements along and taxes, externalities, etc. So the ideas are quite similar once you get to this point. And we can also consider housing. Housing is actually a form of capital. It's something that you build and it sits there for a while, much like a factory or much like a truck, food trucks in particular. Difference is housing is occupied by people for the most part, kind of by definition. You live in your house, you live in your home, you live in your apartment. Whereas you're not, so you're producing another kind of service. You're producing the housing services, the benefits of living in the house. So deriving it in this case is very much the same kind of ideas. And the only thing you want to think about is how do you think about the rental price? So you're going to have a supply of housing based on the marginal cost of producing. You're going to have a demand for housing based on the rental price. Same kind of considerations before. You're going to get increased demand for housing, just like any other unit of physical capital, increase in the quantity demanded when the rental price falls. The only thing to think about is what about home ownership? What about how does home ownership affect it? And how does that price of housing, which we showed at the beginning of this lesson, move up and down and why over time? So for this, we need to go from market for rental housing, which of course is very common. People rent apartments, people rent houses all the time. It's nothing unusual. But how do we convert this thought about rental price of housing into ownership? And here's how this works. So in the case where people buy a house, there is an implicit rental price of housing. Just as we illustrated for food trucks or for computers, there's an implicit rental price for housing, just as there was an implicit rental price for those other types of capital. The definition is exactly the same. It's the interest plus depreciation. It's what you have to pay to own that house, to keep living in that house. You have to pay interest on a loan to buy the house. And of course, the house will depreciate over time, depending on what's happening in the markets, or depending on what's happening to the quality of the house. So for example, suppose the house costs $200,000, and suppose the interest on the loan is 5%. Suppose the house depreciates by $12,000 in a year. Then the implicit rental rate is going to be 0.05, that's the 5% interest, times the $200,000, that's the interest you're paying to the bank on the loan. The loan, because in case of a house, it's called a mortgage. You're also going to have depreciation of $12,000, and so the total implicit rental rate for the house is $22,000 in this case. And so now what you're going to think about in terms of deriving the demand for housing is to look at this implicit rental rate. And the implicit rental rate is higher, and we would argue there's a smaller quantity of houses demanded. If this implicit rental rate falls, the quantity of housing demand increases, just like we showed in the diagram for physical capital, just like we showed in the diagram for rental houses. Now the same thing is happening for the implicit rental price in housing. And now you get this interesting phenomenon that the demand for housing depends negatively on the interest rate. How did we get that? Well, remember, the implicit rental price depends on the interest rate. The higher is the interest rate, the higher is the implicit rental price. Interest is included in the implicit rental price. So that means if interest rates go up, the implicit rental price goes up, and therefore the quantity of demanded of houses goes down. So it depends negatively on the interest rate. That is, that demand curve for housing is negatively related to the interest rate. And we have an important issue that takes place when you think about public policy. I want to emphasize that going back to the very first diagram in this discussion, and that was the diagram that showed the increase in the median price of houses in 2003, 4, and 5 during that period. That was also a period where interest rates were quite low in the United States. Interest rates are determined to some extent by the central bank in the United States, the Federal Reserve. We'll be talking a lot about that in future lessons, but the interest rate was held relatively low. And so based on this kind of a theory, based on this kind of a model, that would make the implicit rental price on houses low. That would increase the demand for housing, probably would start to accelerate the price of housing and cause this boom here. And eventually, when interest rates had to come up, again, the bust. So it could very well be that this housing phenomenon is related to those movements in interest rates. And while we're looking at this graph, let's add one other nuance to this discussion. When we talked about the implicit rental price on housing, we added not only interest, we added depreciation. Sometimes, if housing prices are expected to rise very much, you might think your house is not going to depreciate in value, but appreciate in value, actually increase. And when that happens, that's a further mechanism that reduces the rental price and capital. In fact, you might earn money by holding the house. Implicit rental price on capital might be negative. And so that's going to generate even more demand for housing. And what happens in times like in this picture where the housing prices are starting to accelerate rapidly, you'll see a situation where people say, hey, this is a good deal. Rental price is really low. The implicit rental price is really low. I'll get a house that bids up the price of housing even further. And that keeps going until people realize it can't go anymore. This acceleration phase here is sometimes called a bubble in economics. Eventually, the bubble will reach a peak and it bursts. And that burst in the bubble is, according to some economists and some theories, an important reason why there was a financial crisis in 2008 and 2009 in the United States in particular, but in other countries. So you can see by thinking about the demand for physical capital, recognizing that housing is an example of physical capital, thinking from the basics about what determines that demand, and that's by a consideration of the marginal revenue product for a firm or the marginal benefits of owning a home or living in a home for consumers. And in fact, that depends on these rental prices and implicit rental prices. Once you got that, you realize that both interest rates and depreciation and appreciation affect that, and you have the beginning of possible explanations for remarkable movements in housing prices as we've seen in this picture. Thank you.